This conference will now be recorded.
So, good morning, everyone. Welcome to today's Harts webinar. Today, the session is on pensions, and we will be joined by Phil Gammond. But before moving on to Phil, let me introduce myself. I'm Chris Bentley, Tax and Forensics Director here at Harts. Hopefully, you will now see a screen with the Harts logo on it and the Harts office. Before going into the webinar, which Phil will kindly present for us, I just need to take you through a few formalities. The first is the disclaimer that we have to put on these things. The following presentations are produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by any attendees of this presentation. Just put a few other places where you can see Harts online resources up first. We're on LinkedIn. Please do follow us on LinkedIn. This webinar will also join all of the others that Harts have done on our YouTube channel later on, probably today, possibly tomorrow. We also have Twitter and Spotify. So a couple of upcoming events that we have. 22nd of November. Yes, it's budget day, but it's also our quarterly business club. So if you'd like to come along, hear 3 interesting speakers, as well as have a decent meal and do some networking, then please do let me know or go onto our website and book onto that. On the 30th of November, we're doing our webinar on the autumn statement, budget, whatever you want to call it. Deliberately going slightly later because with a week's notice, we get the chance to actually see what the Chancellor's really thinking about and understand it, and therefore think about what it might mean to everyone. And then we'll have a break for Christmas after that. And on the 11th of January, we'll do a webinar on thinking about selling your business, what you might need to think about if you've got a business sale on the horizon. What else are we seeing in the world at the moment? Well, the latest purge from HMRC seems to be relating to mortgage interest on property rentals. Those of you who have rental property hopefully already know that you can no longer deduct the mortgage interest from your rental income. Instead, you're given a relief that's 20% of the amount you spend on mortgage interest. Basic rate taxpayers, it all washes through. Higher rate taxpayers and those close to the higher rate threshold tend to get a bigger bill than they used to. Some people haven't processed that properly, and so the Revenue are currently sending out their nudge letters to get people to check their tax returns. Yeah, it's self-assessment time, 31st of January, it's not that far away. Yes, people are increasingly focused on what they need to do for Christmas, but you've got 6.5 weeks till Christmas and 4 weeks in January to sort it out. We'd obviously like your information by now if we do your tax return. If you do your own or someone else does it, it's the time to look at it too. And then finally, and I think we've mentioned this previously, research and development. It's gone from being the relief that the Revenue wanted you to claim to something they're looking at very closely. That doesn't mean you shouldn't claim R&D if you are genuinely doing R&D, but it does mean that if you're borderline, you might want to look at it very closely, may not claim if it's borderline. If you are doing a genuine R&D claim, it needs to be done properly, and you need to go into it with your eyes open that the Revenue may well choose to challenge and look at it. If you do get a challenge, then yes, we are available to help with that too. And so at this point, I'm going to hand over to Phil, and hopefully we will have a picture of Phil.
It's not there yet, Chris.
Is it coming up? Hopefully there.
No,
You
we're
seeing
not
it?
there yet.
What are you seeing? Sorry, Phil.
Just everybody's names and little squares with their names on it. Right, there we go. That's me.
Yeah, there we are. Hopefully you're now seeing yourself.
Yeah. Okay, thanks, Chris. So thanks for asking me to speak today, and everybody, thanks for attending. My name's Phil Gammon, as you can see. I'm a chartered pension specialist. So Chris is managing the presentation and any questions. So if I just say change screen, please, Chris, then we'll go on to the
Yeah,
next.
I will do that for you.
Yeah. So next screen, please. Okay. Just to give you a little bit of background about me, this is me when I started work in 1979 in the pensions department of Sun Life. To put it into context, it was 10 years after the moon landing and 10 years before the fall of the Berlin Wall. So basically, I've been dealing with pensions for a long time. So if we could, next slide, please, Chris. I'm going to talk about pensions today. And often when that word mentioned, this is the reaction. Whether you run a company or it's your own personal pensions, there's sort of two things that spring to mind. Firstly, that pensions are complicated, which they are. And secondly, that the rules keep changing, which they do. So what we were set up to do is to take away the stress from people, employer or your own individual pension arrangements. So next screen, please, Chris. So what we do is we give people a roadmap, and what that involves is looking at where you are now, looking at where you want to be, and obviously giving you a path of how to get there. We've already established that pensions change, so of course you need someone alongside you to help you, and it might be your own circumstances that change, or the rules might change as we go along. So that's what Sea Green does. It helps people with a pension to take the stress away from them. So can I have the next screen, please? So what I'm going to talk about today is relatively briefly go through the budget changes that were announced in the spring budget in March. I'm also then going to go on to some interesting points about pensions, which are not related to the budget, but just things to bear in mind. I normally don't do presentations with lots of words and numbers, but I have on this occasion because I presume everyone will be able to have a copy of the presentation, so there is information in there you can refer to. Interestingly, we had the King's speech a couple of days ago. We didn't really think anything would change, but it wasn't actually mentioned at all, pension. So we can safely go on with what's in this agenda for at least the next 2 weeks until we have the autumn statement. So apologies for the lots of words on this, but I'm not going to read every word. It's just so you've got something to refer to if you need to remind yourself of some of the stuff in it. So can I have the next slide, please, Chris? So the big pension announcement from Jeremy Hunt was that the lifetime allowance is being what he called abolished. The lifetime allowance is the pension pot you're allowed to have before you pay extra rates of tax. It's been around for a long time and it's changed a lot over the years. It's been quite controversial, particularly in the context of NHS consultants and senior people at the NHS. Because what's happened is that a lot of people who exceeded the lifetime allowance decided that it wasn't worth accumulating any more pension and therefore left. The wisdom of that remains to be seen, and I'll briefly touch on that later. So the headline was that the lifetime allowance is gone. You can have as big a pension pot as you like. When the spring budget happens, which is always just before the end of the tax year, the next tax year, i.e. the one we're in, there are always interim measures. The reason for that is we need a finance bill, a finance act, and guess what? A King's speech to bring them into force. So it's always late in the year before the new rules can be enforced. So broadly speaking, there's no lifetime allowance anymore. However, if you exceed what the old lifetime allowance was, which was just over £1 million, the figure's there, anything you draw out above that used to be taxed at 55%. It's now been changed to marginal rates. And what marginal rates means, of course, is 0, 20, 40, 45%. Obviously, all of those are less than 55. So really, what this means is that people will pay less tax if you exceed the lifetime allowance. I think most people are aware that when you've got a pension pot, you can draw a quarter of it tax-free. What happened in the rules was that it was frozen at the old rate, which is 268,000. So despite the fact that the lifetime allowance has been abolished, it actually will still apply in some circumstances. And there's no indication that there's going to be any link to inflation. So basically, for most people, the maximum lump sum you can have is 268,000 and odd. So can I have the next slide, Chris, please? Now, again, as you may be aware, apart from the lifetime allowance, there's a thing called an annual allowance, and that is how much money you can put into pension each tax year and get tax relief. There is actually quite a lot of confusion on this, particularly when you include carry forward. I'm not going to go into a lot of detail, but if you're either personally or through your business wanting to put large contributions into pension, and you want to understand how the rules work, then we need to talk. Couple of pointers. Whatever your annual allowance is applies to what contributions you and your employer make together. Your personal limit is 100% of your pay. So if you're a company director, for example, you probably pay yourself somewhere like £10,000–12,000 a year and then pay the rest in dividends. If you pay yourself £12,000 a year, your limit to what you can put into pension and get tax relief is £12,000. Doesn't matter how much carry forward you've got, it's £12,000. However, most people who run their own companies making pension contributions do it as an employer contribution. And the only limit to that is what the annual allowance is. It doesn't depend upon what you pay yourself. As no doubt Chris would confirm, there is a rider on that making large contributions are on the face of it fine, but they have to pass the wholly and exclusively test. I don't think that it's ever been challenged, but it's just something to bear in mind because you can make substantial contributions. So one issue you might think about if you're approaching the old lifetime allowance of £1 million is whether it's worth making a large contribution. Again, if you're in that position, then we need to talk. So can I have the next slide, Chris, please? So what changed in the budget was the previous allowance was 40,000, it's now 60. It's been all over the place. It's been 50, it's been in the hundreds of thousands, but at the moment, it's now 60. In the last 3 tax years, it was 40. Well, what carry forward means is that you can use up 3 previous years and this tax year. So you can, in theory, as an employer or individually, put in 180,000 in this year, obviously 60 plus 3 lots of 40. 2 riders on that is that you need to have what's called being a member of a registered pension scheme in the year you're carrying forward from. Now, most people will have been. You don't have to have made a contribution, but if you, like me, in the late 80s had a rebate-only personal pension or you've got a workplace pension scheme, then that's fine. If you've made contributions in this year or previous years, then you just knock that off your 180,000 limit. So can I have the next slide, please? There is a bit of a trap in the annual allowances called a money purchase annual allowance, which is £10,000 now. It used to be £4,000. This is where someone takes even £1 of income, what's called flexibly. And by flexibly, we mean things like drawdown. Taking your 25% lump sum's fine, because by definition, it's not income. If you do that, then, i.e., are subject to the money purchase annual allowance, you don't have any carry forward available and you're stuck with it. So it applies forever. The reason this can be an issue for people is that somebody retiring and taking benefits probably isn't intending to make contributions in the future, so that's fine. However, if you do, and the example would be somebody who's got a current pension scheme but has an old pension that they just think, okay, I'll cash it in. It's a few hundred quid, it's a couple of thousand, whatever. I'll cash it in, pay a bit of tax, and I'll use it for a holiday. You have to be very careful, because if you're intending to make contributions going forward, instead of having 60,000 plus 3 years of carry forward, you've got 10,000 with no carry forward. So again, if anybody's got a small pension or even a large pension, it doesn't matter how big it is, and you're thinking of taking it, then before doing so, then we need to talk. So can I have the next one, please, Chris? The third annual allowance is what's called a tapered allowance, and this basically is for high earners. So this is £10,000 limit, and it applies to anyone who earns more than 360,000. So clearly that doesn't apply to that many people, but it does apply to some people. So if you earn more than 360,000 in a tax year, you can only put 10,000 into pension. It differs from the money purchase annual allowance in two big ways. One is you still have carry forward available, and the other one is that it only applies in the year that you have the high earnings. So if you had one big year and earned a very large amount of money, your limit's £10,000. But if you then go below 200,000 in the following tax year, you can go back to putting 60,000 in. So you're not stuck with it. I mean, obviously it's not a bad situation to be in, of course, but it's just to be aware of what your allowances are. So there's 3 allowances. They all changed in the budget. I'm pretty sure they'll change again in the future. So again, if you're looking at making contributions to pension and getting the best benefit out of it, then we need to talk. So can I have the next slide, Chris, please? So I'm going to fairly quickly go through these. Some people have what's called protections. That means they've got a different and higher lifetime allowance for various reasons. The first 2 actually were brought in on what was called A Day. We've had lots of A Days, but this particular one was April 2006. So there are some people out there who have very large allowances for their lifetime allowance. We had a client who had a fund of about somewhere between 9 and 10 million pounds, who took enhanced protection in 2006, and when he took his benefits a few years ago, he was able to have a very large lump sum. It's about £2.5 million. He wasn't able to put contributions in. That's something to be careful of. So there are people out there with much larger levels of protection than standard. Can you have the next slide, please, Chris? At the same time, there was a thing called primary protection that applied, and people with primary protection will have a lifetime allowance of at least £1.8 million. So if you've got that, great. You can't actually lose it. You can make more contributions now. Anything that you put in post April this year doesn't count towards lump sum, but basically you can have a higher lifetime allowance. Those 2 protections are gone. You had to have had them at the time, so you can't opt for them now, unlike one of the ones I'll talk about in a moment. So can I have the next slide, Chris, please? So we had a fixed protection. This was brought in at various dates. You can understand why pension starts to look a bit complicated when you look at this, because there were 3 key dates when various lifetime allowance limits were introduced. I won't dwell on this too much because you've either got it or you've not. It's now not available, but you have to have applied for it at the time. So can I have the next slide, Chris? This is the last protection. This is called individual protection. Again, it was brought in a couple of dates, and that gave you a maximum lifetime allowance. The reason that this is important is because if you think your pension fund was more than £1 million on the 5th of April 2016, whether you've put contributions in or not since then, you can actually apply for this. So we know that the lifetime allowance is now basically frozen at just over £1 million. So if you're able to fix it at 1.25 million, then the consequence of that is you can have a bit more tax-free lump sum, which everybody wants. So if you think that you may have had a pension pot of more than £1 million on the 5th of April 2016 and you haven't applied for protection, then we definitely need to talk. There is rumours that this loophole will close in April 2025. So you might not have a lot of time to do it. One of the issues with it is actually trying to find out what your pension value was on the 5th of April 2016. So it depends on your pension provider. But if you think you're in that ballpark, then we definitely need to talk. So can I have the next slide, please, Chris? So I think we all know that when Jeremy Hunt announced the change to the lifetime allowance, that the Labour immediately stood up and said, it's a terrible idea, it's tax handouts to the wealthy, and they were going to reverse it if they get in power. They've since come back a bit from that position because when you actually think about it, it's really difficult to do for lots of reasons. Because one of the main ones is that Labour would actually be saying that there are the right and wrong kind of wealthy people. So you're okay, you're not. So that leads to lots of potential discrimination. And I don't know if any of you are aware of the McLeod remedy in the public sector pension schemes, where the government actually introduced an element of discrimination. And now there's massive unravelling of that being done, and it's going to cost a lot of money. So it's going to be very difficult. Labour could scrap the increase, but they'd have to scrap it for everybody or not. I don't think they can do anything in between. A couple of points. If the Conservatives get back in power, they've not exactly got a great track record in terms of pensions. They could always change the rules again. We know that the King's speech didn't have any changes in it. Normally, that's just affirming the stuff that was in the March spring budget. We've got an autumn statement in a couple of weeks, as Chris mentioned. There's a lot of stuff on the agenda for pensions, but it's likely that the autumn statement will only clarify some of the points, because even though some of these rules came in on the 6th of April, we still don't know the detail. So the autumn statement, we would expect to clarify some of the fine points. And as you may have seen, that Rishi Sunak seems quite keen on changing inheritance tax. That could have an influence on pension planning, and I'll touch on why a bit later on. So can I have the next slide, please, Chris? So advice is critical. This is the sort of crux of what I'm talking about today, why people should take advice. So can I have the next slide, please? So when you've got someone who's got a pension question, it can be relatively straightforward to find the answer. You know, how much lump sum can I have? Well, if you're over 55, you can take your benefits. It's 25%. You can probably find that by asking someone or going online. However, what advice is about is whether you should. And further than that, when you're talking to individuals, then they'll have lots of other things. You know, there's a range of assets that they might have, ranging from debt, you've got cash, you've got ISAs, which could be stocks and shares or cash. You've got other pensions, of course. You've got things like unit trusts, which are normally investments. You've got buy-to-let property potentially. And more commonly, people will have things like cryptocurrency. So even though the answer to the question might be quite easy, it's how it interacts with everything else that's important. You've got a bag of different kinds of products, and you've got a bag of different kinds of taxes. You've got inheritance tax, income tax, capital gains tax to bear in mind. So just answering a question with a factual answer doesn't really cut the mustard. It's, well, we can't even tell you whether you should do X, Y, or Z without understanding your full circumstances. So if you could go to the next one, please, Chris. Further than that, most people I deal with are, have got a partner, husband, wife. They might have considerations about siblings, children, parents. So again, you have to understand the situation for both of them. What's the most tax efficient way for either putting money in or taking money out? You need to understand the overall family situation. Typically, people take advice in this country from friends and family or online. And as I say, sometimes that information may be factually correct, but does it actually cover all the bases? The oddest one I've ever come across for people taking advice was a chap a few years ago who told me that he wanted a third-party opinion. So I said to him, well, if you want specific figures, you'll need to speak to a consulting actuary who will give you very specific information. And I said the downside, of course, is that will actually cost a lot of money. And what he said to me was, if you'll move on to the next slide, please, Chris, was he said, yeah, I might do that, but first I'm going to have a word with my barber. Now, no offense to barbers, but this sort of just shows you what sort of things you come across. I'm sure as professionals, we all get this kind of thing, that interestingly, due to my age, which you've already mentioned, a few of my friends are at the point of retiring, and believe it or not, we still play football. And I was talking to one of the lads in the pub the other week about pension planning, and I thought, this is literally getting advice from the man down the pub. The difference is, of course, I know what I'm talking about. So go to the next slide, please. So just a couple of points here, just about some sort of snippets of information which may not be apparent, but fairly straightforward. If you can move to the next slide, please, Chris. It's really important. You've got various allowances, pension, ISA, various things that you use them all. And just bear with me on this because there's a lot of maths in it. But if you have a couple, it's really efficient for them to have, as far as possible, equalised pension pots. And just to give you some numbers, between a couple, if they take £67,000 out each in a tax year, they'll end up only paying basic rate tax. The way the numbers work is that of 67,000, you can have a quarter of it tax free, so you're down to about 50,000. 50,000 is near enough the upper limit for paying 20% before you go to pay 40. So if you've got two people with large pension pots, they can each draw out 67,000 in a tax year, and the net position would be about 120. If it was one person to achieve 120,000, you need a pot of 160 on current rules and rates, of course. So the message here is that what tends to happen is one person may have a much larger pension pot than the other. And of course, it's not always possible to equalise them, but you need to use the allowances. For example, if we go to the other end of the scale, how much can I draw out of my pension and pay no tax? That figure's just under 17,000. Same process. Take 25%, you're down to 12,570 or whatever the figure is. So in a tax year, you can draw that money out of your pension and pay no tax. Now, obviously, you need to bear in mind that it depends what other income you've got, but just as a general rule, and I'll give you a good example of that. I had a client who was a very wealthy guy, very high earner, had a reasonable sized pension pot, but he was subject to the tapered annual allowance, which at the time was £4,000. However, his wife worked part-time and earned £12,000 a year. So what we did is she put £12,000 into her pension. Now, bearing in mind this couple were in their early 40s, if you just think, well, she could put £12,000 away a year for 20 years in theory, which obviously will build up quite a big pension pot. And then on current rules, she could draw out £17,000 a year completely tax free. So it could be very, very efficient pension contributions. I know we've got to bear in mind other income, etc., and that rates can change. But the message is use all the allowances. So if anyone's in this circumstance where they want to look at perhaps equalising pensions as far as possible, then we need to talk. So Chris, can I have the next slide, please? Okay, can I have the next slide again? So I'm going to talk about whether you should put more in than the annual allowance and therefore not get tax relief. This has definitely got a lot of numbers in it, but just bear in mind, it's not always the case that you wouldn't consider putting money into pension, even if you're over the annual allowance. I had a few clients a few years ago, senior guys, all subject to tapered allowance, but the employer had a fixed pension contribution, so clearly they weren't going to turn it down. What they did was they took it as pay and put the money into ISAs, which is fine. However, when you look at the maths, then there is a case for putting it into pension. Now, I mentioned one of the reasons being that your pension pot's outside of your estate, whereas ISAs and pretty much everything else are in your estate. So this is why I said before that if inheritance tax changes, that might colour how you view this. But just again, without really needing to go through all the mathematics, just bear in mind, if you're considering putting more into pension than your annual allowance, then we need to talk, because I can do this analysis for you. Things like national insurance come into play here. That's why. That it's not quite as clear cut as might appear as to put it in and not get any tax relief. So can I have the next slide, please, Chris? So again, next slide, please. So just a couple of quick points on death. If you've got a company pension scheme, you probably have a death in service lump sum, and it's on what's called a registered basis. What I don't think a lot of people realise is that anything that pays out from that kind of scheme on death counts towards the lifetime allowance. So I've given a quick example. You've got somebody who's under 75. That's significant because if you die under age 75, up to the lifetime allowance, the money passes on tax-free to your dependents. If you had £1 million pension fund and £1 million from a death in service scheme, that's £2 million for lifetime allowance purposes. Previously, the bit above the lifetime allowance, which is thick end of £1 million, would have been taxed at 55%. Now it would be taxed at marginal rate, but clearly that's going to be really high amount of tax. It's not been clarified, that's in this tax year, it's not been clarified how it will work in future tax years, but I don't think any of us think that the rules would be that no matter how big your pension pot, if you die before age 75, it's going to be tax-free. It's bound to be subject to the old lifetime allowance. If you're over age, well, 75 or over and you die, then the money passes on and the person receiving it pays tax at their marginal rate. So we know that won't change, and that's clear. It's only if someone dies under age 75. And just a technical point, if you're an employer and you've got a group life scheme and you've got people with high benefits, you may wish to consider what's called accepted group life. Again, I won't go into the detail. It's just something that if you have got a company scheme providing death in service, then again, we need to talk. So can you, next slide, please, Chris. So we've got our chap who was confused about pensions, not knowing where to go. As an employer, you'll be thinking, hang on, I've got enough to do. You know, I've got my day job, running the business, etc. I don't really want all this extra stress of pensions. So if you can put up the next slide, please. The objective is to get to this point. is where that stress is taken away. You can get on with it, and you know that there's someone there helping you with your pension planning. As importantly as helping where you are now is to make sure that going forward, that you're looked after going forward as well. So can I have the next slide, please? So how do we give advice? So if again, next slide, please, Chris. There's sort of three broad ways. The first one is advice to the employer, which I know some of you are. The big pension issue for employers, of course, is workplace pensions. We all, well, pretty much always have to have one. Concerns for employers will range from things like making sure you remain compliant, because sometimes you wouldn't even know. I've come across lots of employers where they've had a really good pension scheme, but because workplace pensions are such a technical thing, you can actually fall foul of it and provide better benefits than workplace pensions, which seems crazy, but that's the case. There's also some problems I know with admin for some of them. Various people have told me that now pensions, for example, that their admin can be quite poor. Nest is okay, but Nest is very basic. So, and one of the other issues for employers is how much it costs. There's again some aspirations of the Conservative government to improve workplace pensions in two ways. One is, as you may know, the minimum age to enrol someone is 22. There's talk of that coming down to 18, so that could be more people in the pension scheme. The contributions are based on what's called mid-band earnings, which are roughly between 6 and 50,000 a year. Again, the proposal is to get rid of the bottom end, £6,000. So, and contributions will be based on all pay up to about 50,000. So for employers, what this means is you're going to have more people and you will be making larger contributions for everybody. So if there's any way of making it more efficient, there are ways of mitigating costs, such as salary exchange. Then I think generally speaking, if you have a workplace pension scheme, then we need to talk. Let's have a look at it. I'm quite happy to look at it and let you know whether it's compliant, what you can do, what the new rules are, what it would mean. So can I have the next slide, please, Chris? The other way, another way of providing information is of course to staff. For larger employers, we tend to do this based on their age because it's quite obvious that the considerations for younger members are different to those near retirement. So a lot of the basics are the same, but when we've done this in the past, it's been split up between different tranches of employee, depending on where they are in their career. So can I have the next slide, please? Finally, obviously, we also do face-to-face, because if there are any changes that are reasonably significant, then obviously we talk to people individually to let them know how it affects them. What we do quite a lot of as well with some employers is, as someone comes up to retirement, we'll have an individual session to go through their personal circumstances. So going back to all the things I was talking about before, about lump sum, about other assets, about partner, husband, wife, whatever, we do a lot of this individual one-to-one. From an employer's point of view, it's great. It's a service we can provide. It makes it easier, takes the stress away from people, because you basically don't want them taking advice from people who don't really know the full story. So if you can have the next slide, please, Chris. These are my important notes. Apart from the services we provide, then we do work with other people, such as Harts, for example, for for if somebody needs accounts. We know lawyers, we know financial advisors. So if anybody needs an external service, and wills is a fairly typical example because a lot of people don't have wills. A lot of people who should have them don't have lasting powers of attorney. We're not legal advisors, but we do have very good relationships with professionals, really good top level people who can help with that. So can I have the final slide, please? So these are my details. I believe you can all have a copy of these slides with the technical information on. If anything changes in the autumn statement, then of course you'll all be informed. And as Chris said, there is a business club meeting on that day. So if there's any of the issues you want to talk about, then here's my details. And if anyone has any questions now, I'm happy to take them. So thanks for listening, and let me know if you need to know anything else.
Right, thank you very much, Phil. That has been very, very helpful. I'm just seeing if any questions have come through. And no, I'm not seeing any at the moment. So in which case, all it falls to me to say is thank you very much, Phil. Very informative presentation, and thank you to everyone else for being on this webinar. I hope you found it useful, and any questions, please do send them to Phil, or if it relates to tax matters, to ourselves. Thank you very much, and bye-bye.
Okay, thank you. Bye.